The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague, Australia's next best bank investor behind Peter Dutton. It's Anthony McDonald. How are you, Anthony?
Oh, James, I'm so far from Dutton's league.
Fair enough. Well, this week we examine the extraordinary drama that's torn apart the WiseTech board. We ask what's behind the bonkers moves in share prices in the last few weeks. And we try to stop the barbecue with a question about house prices. But Anthony, we've done it. We've conquered the mountain that is reporting season and lived to tell the tale. Let's quickly sum up things with some quick awards, which we love here at the Chook Podcast. Let's start with you. Best result, worst result, and the trend that caught your eye.
James, best result, A2 Milk Company.
Okay.
$6 billion market cap, infant formula company. James, they've turned this thing into an actual business. Like when it was hot a few years ago, it was just basically a marketing machine, right? It had a good brand. It'd pump out the infant formula via the Daigou channel in China. Didn't own the distribution. Didn't own the manufacturing. It was making money, but there was a lot of hot air behind it. Now, everyone got spooked as the Daigou sort of got shut down. The birth rate in China sank and A2 was out of favour. But the current management, James, they've come in, they've rebuilt this thing and they've turned it into an actual business. They've still got the brands. They've got the distribution now. It's not going down the Daigou channel, which they don't really own anymore. It's got a stable business in Australia and New Zealand. It's almost doing $2 billion of sales a year. It's making $250 million of earnings. So it's good. I mean, the piece they still need is the manufacturing. Looks like they're getting close to that though. So just for sticking at something, turning around investor sentiment, I'm going with A2 Milk for the best.
We should mention the Daigou channel is where people in Australia used to clear out the shelves of chemists and supermarkets and ship the infant formula back to China and sell it through e-commerce platforms. It was a weird sort of phenomenon that lasted 2 or 3 years, was really hot, but now it's completely folded. Basically, the pandemic killed it, and A2's been recovering ever since.
That's right. What's your best result, James?
My best result is Coles. Maybe a bit of recency bias. This was a result on Thursday afternoon, but Leah Weckett is doing a great job here. Obviously, there's been a regulatory firestorm around these supermarkets business. We've had politicians throwing bombs, the competition regulator throwing bombs, but all through it, Weckett has kept Coles running really well, managing to meet the customer's desire for better value by selling, more home brand stuff, both at the lower end, so your 90-cent packet of pasta, but also at the higher end where you've got people trading out of going to a restaurant and instead, looking to buy some nice stuff from the supermarket on the way home. So playing both ends. I think earnings before interest and tax was up 11%, and she's absolutely stomping on Woolworths in a way that probably looked quite unimaginable. And the interesting thing with Weckett, she's not even past her 2-year anniversary. This is a pretty impressive leader at a business that's rocketing along.
While you're going, James, because I think I know what you might say here, give us your worst result.
Yes, my worst result is Woolies. So I just said Coles was up. Coles earnings were up 11%. Woolworths earnings were down almost 13%. And they had a few sort of own goals, I guess. They had this industrial action, you'll remember, at the end of December.
Down in Victoria.
Down in Victoria, which sort of crippled their supply chain down here. It lasted a few weeks. So that didn't help. And, the CEO, Amanda Bardwell, she also called out the ACCC action. But you sort of look at it and you think, hang on, Coles had exactly the same headwinds around the ACCC taking legal action. Coles had exactly the same headwinds around politicians getting stuck into the supermarkets. And yet Coles managed to produce some impressive profit growth. So I just think Woolies it's lost its way a bit. The analyst call here was quite remarkable. Analyst called David Errington from Bank of America, who never takes any prisoners. He told the CEO that the company is uninvestable and it's going backwards. And really that sort of sunk into the market psyche. So this is a real Contrast, Woolworths has also got problems in Big W and its New Zealand supermarkets business, both going poorly. There's a big turnaround here required at Woolworths, and will that turnaround require a price war? I'm not sure. Coles would not be happy about that, but let's see how it plays out. Anthony, who was your laggard of profit season?
My worst result was the top traded stock on CommSec last week, James. The biggest retail broker. That's Mineral Resources.
Ah, yes.
You know, and the poor old CommSec customers, 74% of the trade last week was buying as well, a week when the stock went down 20%.
Mm-hmm.
So I do feel for them. But like we all know, Mineral Resources is crunched by iron ore price and lithium price. And it's been having some teething problems with this big new Onslow iron ore mine that it's built, including the haul road, which got partly washed away by a tropical cyclone. And James, we know
the road got washed away by a tropical cyclone.
Partly washed away. Huge volume of water.
They have tropical cyclones up there all the time. How
They
could
do.
you build a road that wasn't ready for it?
You sound like you're on the analyst call, James. They didn't asphalt it. Anyway, now they're asphalting it. It's going to cost a couple $100 million. Anyway, and we know there's governance problems, James, around Chris Ellison, who is due to leave the company, although I'm still not entirely convinced he thinks he's on the way out. But so the numbers were ugly, James. EBITDA halved. The statutory loss was $807 million, a huge statutory loss. But anyway, none of that is why I'm nominating them for worst result, James.
Right.
Worst result's the balance sheet. This thing's got $5.1 billion in net debt, $650 million more than it had 6 months ago, at a time when its earnings are absolutely under the pump. Now, that debt balance is still stubbornly big and growing, despite the fact it's been selling assets. You know, net debt's worth 7.4 times underlying earnings. Now, that is nosebleed territory for the Australian market, James. Now, management's done a few things, says they're doing a few things that can knock it down a bit, but, James, there's a long way to go on this. So, that's my worst result.
Right. What about, Anthony, the trend that you'd sort of call out for people to follow as we go through the next few months?
Yeah, trend, James. You know how your mum used to tell you that if you don't have something nice to say, don't say anything at all?
Yes.
Well, in corporate Australia, if you've got nothing nice to say, announce cost cuts.
Right.
Then the investors will at least think you're doing something about it. Now, businesses in tough industries, tough conditions, you know, think your Woolworths, Nine Entertainment, Bapcor, the car parts retailer, Viva Energy, which is in petrol stations and struggling with sales. They're all announcing cost cuts, right? They're not growing revenue, and to show investors they're doing something about protecting earnings, they're announcing cost cuts. Now, I know this is probably not a new trend, James, and that's probably CEO 101 stuff. But in the past week, it really dawned on me how prevalent it is. What about yourself? Any trends?
The big one that I've picked out is Victoria, where I am sitting today. We had Ryan Stokes, the CEO of Seven Group, or SGH as it's now called, declare that Victoria was in recession. And I've kept asking CEOs about this. So, but it's everywhere. Wesfarmers, Dexus, JB Hi-Fi, Super Retail Group, ARB, the four-wheel drive parts maker, Stockland, the property developer. They've all pointed to some weakness in the Victorian economy, slowdown in activity, long-lasting problems with policy settings like tax and payroll tax particularly, and land tax. It's not good. I mean, if you're an investor, be wary of companies with big Victorian exposure. If you're Anthony Albanese, be wary of a backlash from Victorian voters in the upcoming federal election. It could get quite nasty.
Yeah, good point. Now, you're obviously in Melbourne, James. What's it feel like when you're walking down the street? Like, does it actually feel like times are tough? What's your famous milkshake indicators telling you?
I think this will sound like a stupid answer, but it really depends on what time you walk down the street.
Uh-huh.
If you go down the street of an evening on a Friday night, Saturday night, even a weeknight, the restaurants are pretty full. The bars look like they're doing a pretty brisk trade. So there's money out there. But then in some of the, walking down the streets of some suburbs, there's a lot of empty shops. There's a bit of pain in sectors like construction and property and retail and hospitality. So it's a very mixed picture. The milkshake is half empty, perhaps, is the way to think about it.
Okay, James, I wanted to quickly ask you about a big report released this week by the corporate regulator, Asic, examining how public and private markets are changing. James, it was a chunky bit of work, but basically a few dozen pages setting out the public and private markets landscape. But what was your big takeaway from it?
My big takeaway from it, Anthony, is that Asic is interested in what's happening is really keen to understand more about what's happening in private markets. So think private equity and private credit. It doesn't know enough about what's happening in there, but it can sense that investors, including every one of us through our super funds, are becoming more exposed to this. So it wants to know, how are assets valued? How are returns generated? How are those returns disclosed to investors? Who's making money? Is it investors or is it the owners of these private equity and private credit businesses? Asic, I think, has a suspicion that this could be the source of the next financial crisis. Whenever there's a financial crisis, everyone looks at Asic and goes, hey, why didn't you tell us about it? It's trying to be proactive and get ahead of it. And that need to get ahead of it is amplified by the fact that super's so big and it's in all this stuff. So I think if you're in private credit or private equity, expect to have to tell the regulator a lot more about what's going on inside your business over the next couple of years. And, I think that's probably a healthy process. They'll become a healthier part of the economy and a bigger part of the economy, but the regulator's right. It needs to be on top of this. What did you take out of it, Anthony?
I agree. I mean, don't look up this report and expect to find answers, because it's not about answers. It was basically a list of 15 questions about public and private markets with a whole lot of landscape around it. To me, though, James, I thought it just hammered home how important public markets are. Like, yes, private markets are growing and there's heaps of salespeople out there great talking them up. And lots of very smart people there, and a lot of them making good money as well. But it's public markets that are hugely significant to Australians' everyday life. I mean, I wrote a column saying that, James, public markets, when the government needs to raise $100 billion in a quarter in COVID, goes to the bond markets. That's where our biggest taxpayers are, biggest employers are. It's where our banks raise capital to write mortgages. Australians, like 3/4 of our retirement savings are invested in public markets. I mean, that's really the bread and butter. For right now, for Asic though, I mean, it's thinking about what goes on in private markets, how that can also spill over into public markets. So I think it is very important piece of work that they're doing. It's just not at the phase though where there's any answers. No. This really was a discussion paper. Yeah,
and there's nothing wrong with that, but you're right. There's another 5 years of work for Asic to get to here, and I reckon it's good they've started on the journey. Okay, Anthony, let's move to our first topic. Over the last 6 months or so, we've spoken a lot about the drama surrounding WiseTech Global, the $33 billion logistics software business run and co-founded by Richard White. After a series of scandals in the billionaire's personal life spilled over into his professional life, last October he stepped down from CEO to a consulting role, or so we thought. A few weeks ago, it became clear that he hadn't actually signed the consulting deal. And then on Monday came the bombshell. The chairman of the company and 3 other independent directors resigned en masse, declaring they could no longer work with White. A few days later, it became official. White was back, this time as executive chairman, effectively giving him more power than he's had since the company listed back in 2016. Anthony, I am a bit dizzy. White was on the way out. Now he's back in. What on earth is going on here?
How good is our job, James? We come to work on Monday morning. There'd been a cracking read on Richard White in the paper. The stock had been in trading halt for a few days on governance for a governance update. We knew something was coming. One of us would be writing about it. It would be big news. But I mean, the obvious one was that Richard White was stepping away. He'd been going backwards for a few months and looked like, after a fantastic run, this bloke who founded a business 30 years ago, 70-something-year-old, billionaire many times over, looked like he was on the way out. But no, it was entirely opposite, wasn't it?
Yeah.
It was more bizarre, I think, and unprecedented than any of us would have guessed. But I guess it makes sense, right? Like, White's used that trading halt, the frantic weekend of talks, to return from the dead, really. A Lazarus-like performance. And instead of him going, these 4 independent directors,
they've been rolled.
They had to go. You can't have a situation where you've got such a powerful person in a company, a big shareholder, and the board at loggerheads. So there has to be a winner and there has to be a loser in that case. Now, the mass resignations, James, farcically, it reduced the board to 3 people. You've got White, his former business partner, Marie Isaacs, and longtime investor Charles Given. They recruited a 4th director, a former director and an investor as well. So it was all just bizarre, James. And then 2 days later, WiseTech results day, everyone tuning in. Again, another bombshell. White was coming back as executive chairman. Now, the executive chairman bit, James, I actually like that because, if he is going to be calling the shots and if he is in power, at least give him the title. You know, let's not pretend. But yeah, I just came away astounded, James. I mean, you wrote about it on Monday. What do you think actually happened in that boardroom over the weekend?
Oh, I think Richard White rolled them, basically. Yeah. He flexed his muscles. He owns 36% of the company, probably speaks for 50% of the register through connections he's got. He decided that he wanted to be back in town, and that's the end of the story.
Yeah.
I think it's really as simple as that. And White can claim a victory in this power struggle, but I think also those independent directors can claim a sort of moral victory too, that they've been effectively told that they're not wanted, that they're on a different page to the chairman. Their checks and balances aren't required. And so instead of sort of limping along or trying to patch things up or pretending that everything was okay, they've taken their bats and balls and gone home. I think there's something sort of dignified in that, to be frank.
Yeah, absolutely. Now, James, you're a resident corporate scandal watcher. You did the Banking Royal Commission, a litany of casino inquiries. Tell us, is it actually good or bad that Richard White is back in control?
I don't think it's great that Richard White is back in control in this way. I don't think it's great that Richard White's come back to the company and the independent directors, who I think are an important check and balance for minority investors, they are nowhere to be seen. They are gone. Now, is it good that for investors that Richard White, the genius, and he is a business genius behind this company, is back in charge and back running WiseTech's product and business development functions? Yes. But is it good that he's back in those roles with all these accusations still hanging over his head and no one on the board to provide the independent checks and balances that a board's supposed to have? I don't know. But Anthony, we are seeing a bit of this, a scandal, board action, and then the fight back from the boss or the founder. What does it say about where Australian investors' heads are at on ESG matters and particularly the G for governance?
Well, James, I think I'm pinching your line here, but it's money talks, ESG walks.
Yeah.
Right? Like, it's that simple. I mean, we're all the same. It's easy for you and I to sit here and tut-tut about corporate governance problems, without any skin in the game. We're completely impartial. It doesn't impact us whether WiseTech shares will go up or down, but it's amazing. You speak to investors, as soon as you have skin in the game, as soon as you own the shares, it's very hard for people not just to follow the money. And sometimes the following the money means doing the right things in terms of governance. Other times, good governance requires you to take a short-term hit, like it would here, James. Maybe risk losing some money to get a better or more sustainable end state. And at the end of the day, though, Richard White's WiseTech and WiseTech, whichever way you look at it, revenue, earnings, share price, whatever, it's been a phenomenal company for investors. Yeah. Richard White's been phenomenal for investor returns. So now that he's up to his neck in crap and like he's right up to his chin, like it is everywhere. There's a lot of it out there. Do you wave goodbye to him and risk losing the special sauce? I mean, do you take the potential 30 to 40% immediate hit of really forcing him out and maybe having a fractured future where you've got a big shareholder and his former company at loggerheads? No, I mean, that at the end of the day, that's just not what investors want. So, James, it tells me that governance standards are great in textbooks. They're easy for people like us to talk about. And they look great. Governance principles look great on the ASX, but when you get money involved and big money at that, James, you can pretty quickly toss out some of these principles. Investors at the end of the day, they just want to make money.
Yeah.
And they'll do what they have to make money. And if you look back, right, at CEOs that have been turfed out or been squeezed out or resigned, and there's governance concerns around them, you'll not find many of them dropped while the going was really good. Most of them, if you look back, the business was already really under pressure. They were probably going to get done for underperformance anyway, and the governance is just the thing that breaks the camel's back. But what happens from here, James? I mean, Richard White, is he unassailable? What would have to happen for him to lose his job at WiseTech or, get turfed out or even demoted again?
I don't think he's unassailable. There's a lot of accusations still swirling around. The board is supposed to be reviewing them with the help of a law firm. We don't exactly know where that review is going to land now because you'll never guess, Anthony, but the review itself is going to be reviewed to see what it was going to come out with. So look, I mean, if some of these accusations, or we see more accusations about Richard White emerge, there's every chance that the board, small as it is now, may have to act. And where would investors be then, Anthony? They've lost the independent directors and they might lose Richard White. I mean, that is a disastrous situation. Yeah. So I think there's a lot more water to go under the bridge. There's a lot more work to stabilise this company. There's a lot more for White to get through and sort of have these accusations dealt with. So I don't think this is over from any stretch of the imagination. I'd just point you to, I get exactly what you're saying about investors love a founder. They love a founder that makes some money. I heard all the same things about Chris Ellison, the boss of Mineral Resources. And in fact, we saw after the governance scandal that erupted around Chris Ellison, we saw some investors say, no, don't sack him. We want him to stay because he's such a good moneymaker. And then a few weeks later, what do we find out? This apparent genius of business forgot to seal a road in a cyclone area. I think once you get questions about someone's judgment, you really have to be careful about, how you assess their judgment going forward.
Ellison's still not out though, James.
No, that's right. But investors have paid the price for that, haven't they? The stock's not down, 30% like it was. It's now down 60%. So I just think this is still a really precarious situation. Yes, White's regained control. Yes, investors are sort of okay with that. The stock's still 20% lower than where it started the week, though. So I think investors are still trying to get their head around where this one goes. But the stock's at $94 at the moment, Anthony.
Yep.
Started this month at $120. Where's it going to be in 12 months' time?
Where's Richard White going to be in 12 months' time, James? Seriously, you got to wonder about the personal toll on him through all this stuff, James. I mean, that story last weekend about the volatile relationship with his wife, it was really explosive, and Richard White's been under a fair bit of personal strain. That's got to impact you. I mean, if he's still there, I think WiseTech keeps going in the right direction. I mean, all of this stuff, the governance concerns should make it harder for WiseTech to keep growing as it has been. So one of the big ways it's grown its business is acquisitions, right, James? So it goes around, picks off smaller businesses and then incorporates their software into their own. He generally offers WiseTech Script to do it. If you're now a founder of a little business and you're in talks to sell to WiseTech, you're going to be thinking twice, right? If you're a customer, you're going to sign a big contract with a logistics software supplier, you're going to be thinking extra hard. So, I mean, all that will hang. I think if Richard White gets through this, if he's still there in charge of the company, I think they go up. But the key man risk at this company has just doubled this week. And I think that's the big danger for investors. What about yourself?
I struggle to see how the stock's going to be higher. There's 12 months of stuff to play out here. And it'll take 12 months to win back the trust of markets. Yeah, that could happen quickly with some big results and some, really strong profit growth and revenue growth. But I think investors will just be skeptical. So I'm not too positive.
All right, James, for our second topic, it's been a massive week for WiseTech in terms of its share price. And let's get into the world of markets and making money. We're back to about even on the ASX 200 for this year. The big gains in January have pretty much disappeared in February. Beneath that, though, James, share prices are really jumping around. Every day this week, we had top 200 stocks up or down 10% or more, which is really quite incredible. Usually it was on the back of a better or worse than expected result or outlook statement. Now, James, there has to be a lot of people out there making and losing money in these conditions. Why do you think share prices have gone crazy?
Anthony, it's really hard to... this has been a trend that's been building for a number of reporting seasons. The moves have been getting bigger and bigger on reporting day. No one seems to be prepared to take a few days and sit back and stew on the result and make a, careful, considered decision about where they go next. It's just this emotional reaction. And I think that is probably amplified by momentum trading and algorithmic trading, which is really computer-generated trading. The computers see a move in a share price, and they try and get ahead of it and amplify it by going short, which is when share prices fall. You're betting on a share price fall, or by going long. So I think that's part of it. The other part of it, Anthony, is that the ASX 200 has been hitting a series of record highs over the last few months. So expectations, a lot of stocks are priced for only good news. Only good news. And if you get just a little bit of disappointment about the outlook, about what's coming next for the company, about the macro conditions, then you can see a very fast reversal in sentiment. And that's particularly the case where we've got stale earnings estimates. So analysts haven't been able to spend much time looking at a company. The earnings estimates out there are, a bit long in the tooth, maybe, months old rather than weeks old. And the chances for a surprise are large. But Anthony, the other thing we've had in the market, particularly in the last few years, it's been happening for decades, is a rise of passive funds. So these are low-cost ETFs that track indexes, and they tend to pour money into companies according to their size in the index. Do you think that is a factor in this as well?
For sure, James. Like the rise of the index funds, the ETFs and that's probably been one of the two great changes in Australian equity capital markets in the past 10 or 15 years. And the more I think about this, the more I feel like the index and the passive money has to be part of it. You make a good point there about the stale earnings estimates. That's definitely true. But I think the way that you've got money going into companies based on their size, not their outlook, not their consensus earnings forecast, not their the multiple of earnings, so their price that they pay at, that distorts the way that capital is allocated across the market. Or maybe distorts the wrong word, but it just changes it, right? It's all based on size. So there's buying support for big stocks with a poor outlook or at risk of missing earnings or whatever, just based on the fact that they're big. And then you get an actual result on results day which might be better or worse than expected, and you've got active money who are going to trade on the back of that. And so all of a sudden you've got these share prices that had been actually really inflated by passive money, who are trading more expensive than they should be, and they're going to get knocked down harder by the active investors who are trading on a different sort of set of principles. They're more looking at the earnings and the outlook and the fundamentals. So I think passive is just a giant part of this, James. But I think you could probably ask me any question about the Australian share market and how it's changed and whether passive is part of it, and I'd say yes.
Yeah, that's true.
Because it really is a game changer. Let's delve down a little bit deeper. We've got 10 companies whose shares have tanked 20% or more this month, and 10 who are up 15% or more. So that's 20 stocks out of the top 200 that have had a massive month, either good or bad. Let's go through the biggest winners and losers and see if we can understand why. The biggest loser this month is a company called Block, down 32%.
Yeah, so it merged a few years ago with Afterpay, Outlook in the US. The stock had been flying, but this is a US story. A little bit of concern about the tech sector in the US and a little bit of concern about the US economy. Whammo, down 32%. That's a seriously big move. Viva Energy, Anthony, this is the owner of the Shell service station business. Yeah,
exactly, James. Petrol station company, makes most of its money selling fuel, but it's also bought back the convenience bit of the petrol stations, the bit where you go in and buy the soft drinks and the ice creams and that, all that non-petrol stuff. They've done it at exactly the time that consumer sales are softening. Cigarette sales in particular are getting smoked by the illegal tobacco trade. And everyone's wondering whether Viva Energy has got too big into all that convenience side of the business at exactly the wrong time. James, Mineral Resources minus 31%.
Yeah, I think we've probably touched on them enough, Anthony, but a massive move. Another company called PolyNovo was down 29.5%. That's a seriously big move too.
Yeah, so PolyNovo does sort of like skin or fake skin, if that makes sense, like tissue repair sort of stuff. It reported revenue in line with expectations, but it missed earnings expectations, James. Not by that much, but it is a stock that trades in Australia at a really blessed multiple, much higher than similar companies overseas.
Yep.
So when you miss expectations and you're really trading at a rich multiple, that's when your share price gets smoked when you disappoint. So, I'd put it in the well-supported stock that lost a bit of support camp. Finally, to round out our top 5 for the losers, James, and you looked at this one, Reece.
Yeah, Reece, plumbing supplies business. You'll see it everywhere. The name might even be on your hot water system out the back. But look, another market darling. Investors love this stock. It's trading on a pretty good multiple. and didn't do anything particularly wrong. All it said was things are a bit slow in the Australian housing sector, and they're a bit slow in the US housing sector, which should exactly have surprised zero investors. But apparently they went, oh, geez, I didn't realise that. Sold the thing off 28% in a day. That's a seriously big move too. Let's have a quick look at some winners, Anthony. A2 Milk up 37%. We've done them.
Done that.
Megaport 33%. Not a company I know a whole lot about. This is an AI story, I think. They're a data center business, one of the smaller ones compared to the air trunks and of the world, but they had been pretty beaten up over recent years and rose on better guidance. Again, it's that story of you can surprise people to the upside with better outlook too. Ordinate, Anthony, down up 24%.
Yeah, similar, James. Small cap worth about $800 million. It's bounced back a bit here, but it used to be trading a lot higher. The short sellers, the people that are betting its shares are going down, really attacked it recently and sent the share price down a lot. Now, its result was either a little bit better than expected or not quite as bad as people have expected. So a couple of those short sellers, it looks like they've had to scramble to cover their positions to close out their short. That is to stop betting the share price is going to go down. That creates a little bit of a flurry for buying shares, and it can send the share price up quite sharply. And I think that's what's happened at Ordinate. I'll take the next one, James. Light & Wonder. It does poker machine software. You know, the games on the gaming machines, growing strongly, just did an acquisition, revenue up 10% last year. What caught our eye, though, James, is it's listed in the US at the moment and also trades on the ASX. 30% of the company's shares trade on the ASX.
Yep.
While that's less than a third, it's looking at now moving from the US back to Australia and moving all of its shares to Australia.
Right.
Just in a bid to catch this passive sort of money in Australia and the liquidity that's there
you go.
From the industry super funds and the like, which is actually really interesting because everything we hear, everything we read in the Asic report earlier this week, James, on public markets, suggests the US market is bigger, better, going to the moon, and smaller markets like Australia's struggling. Well, this one's talking about doing a move that goes the other way.
All right, and I'll take the last big rise, Nine Entertainment stocks. Nine Entertainment, of course, is the owner of a range of media properties, including the Australian Financial Review and this podcast. Anthony, there's a bit going on here. We've got, last week we told you about the bid for Domain, which is the second biggest property classifieds business. Nine owns 60% of that, so they've had a boost from that bid. And then there's this week the CEO, acting CEO Matt Stanton, announced some cost cutting, $100 million out over the next few years. And there's a little bit of an improvement in the advertising market. I wouldn't say it's good, Anthony, but it's probably less worse than investors thought. And again, that's just that change between reality and expectations. Up go the shares. Anthony, it's a big spread across the economy. Is there a thread in all that?
Massive mixed bag, James. I think generally, if you look at it, anything with big workforce, life's still hard. Anything that's big energy user, life's still hard. Resources companies, commodity prices are soft. Planning approvals are terrible, even worse than in oil and gas. Banks, hard to find growth. Consumer-facing businesses, funny, JB Hi-Fi's sweet, but the rest of them are struggling a bit. So not really amongst that list, James, but I think we've really discovered some other sort of trends for reporting season that'll drive the market for the next 6 months.
Yeah, indeed. All right, Anthony, we're going to get to a break. We'll come back after the break with a very interesting question about house prices from a very special correspondent. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can go to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Anthony, it's a big week for the AFR next week. We have got our annual business summit, which has a unique ability to happen at a really important time in sort of global business, and this is perfect with everyone's trying to figure out what's going on in Trump world and markets looking a bit toppy and all sorts of things. So I am thrilled to be talking to Steve Schwartzman, who's the big dog at Blackstone. one of the biggest private capital players in the world, so that's going to be great. I'm also talking to Greg Bura, who's the CEO of CDC Data Centers, one of the quiet achievers of the data center business, and Qantas CEO Vanessa Hudson, so that'll be great. What about you?
I've got one of the Chanticleer podcast's top listeners, Matt Common,
Oh,
the
great.
Commonwealth Bank CEO.
Yeah.
Promise not to ask him about his share price for a change.
Fantastic. No,
yeah, and a panel with a bunch of superannuation fund leaders as well.
Oh, excellent. That's going to be great. And as we're sitting down to day 2 at about 11:30 on Wednesday of the summit, we'll get December quarter GDP growth. Last quarter was 0.8% on a year-on-year basis. Anthony, I'm not expecting massive improvement from that, are you?
Maybe a little uptick, but we're not flying.
Yes. And Friday night, our time, the US jobs data, all important here. This is a big moment for the Federal Reserve.
James, hold on. Football season's also coming.
Yes.
Next Thursday, AFL season starts. How are your beloved Collingwood Magpies going to go this year?
Oh, I'm hopeful, Anthony, but the bear inside me can never be quite tamed when it comes to football or markets. So, yeah, low expectations, and hopefully I'll be surprised pleasantly. We'll see how we go.
Oh, good luck.
Thank you. All right, well, this week our question is from, I can't believe I'm saying this, my mum.
Oh, wow.
Yeah, if you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. And that's exactly what my mum Sue's done.
Hello, Chooks. So James thinks he's such a great forecaster now. Can you please tell us, oh wise one, where house prices are going in the year? And pull your head in, son. Keep up the great work. James's mum.
Thanks a lot, Mum. But let me help you by telling you that house prices are going nowhere this year. They might be mildly down in the coming months, but I don't think we're going to get and then the rate cuts we see will probably help them towards the back end of the year. But I don't think we're going to get enough rate cuts to really give house prices a push along this year. I'm expecting them to be pretty flat by the time. But by the time we get to this point in 2026. Anthony, what do you reckon?
A little bit more positive than you, James. I
Okay.
agree that there's not, it's not boom times, but just the way the population's growing. I mean, that's what supports house prices. At the end of the day, population growth, wages still pretty strong, jobs market's still reasonably tight. So I'm definitely not bearish.
Yeah, okay. Yep, no, fair enough. I think there's plenty of first home buyers out there that would love to see the market go sideways for 12 months though. Yeah. So hopefully they'll get a little bit of what they want to see. All right, Anthony, looking forward to seeing you next week up in Sydney town for the Business Summit. We'll bring you all the colour and movement from that next week. It's going to be great.
Absolutely, James, and thank you for a very, very fun reporting season over the past few weeks.
Absolutely. We'll see you all next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson and Anthony McDonald, and it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow, the head of podcast is Lap Fan, and the head of premium content is Fiona Buffini.
The Australian Financial Review.